How's it going, everyone? It's Matty from Logic Effects, and in this video I'm going to be going over why you actually need a trading journal to be successful in trading. Now, the trading journal that I'm going to be covering is our Logic Effects Ultimate Trading Journal Guide. It's one that has three of the main key things you need in trading journal, which is a watch list, a trade log, and a performance tab. And it'll look something just like this, where you can track exactly what the Forex pair or the asset that you're trading is doing, the politics behind it, the economics behind it, market sentiment, and the technical analysis. I'll cover all this just after the introduction. So actually, I'm going to go over the benefits of a trading journal, what makes a good trading journal, but also what makes a bad trading journal, because there's a lot of videos out there that are telling you, to take a screenshot of your trades, start logging them in an Excel sheet. Nah, you don't want to be doing that. Complete waste of time. In this video, I'm going to go straight to the point on what you need for a successful trading journal. So let's jump straight into it. What actually is a trading journal then? Think about it. Why do you need it? Well, it's the place where you can actually start identifying yourself as a trader. You can identify what your weaknesses are, you can identify your strengths, but also you can identify how well you are performing as an individual and as a trader. Why is this important? Well, it allows you to focus on where to improve so that you can make more money on your trades. And without a journal, you don't know where you can improve. So if you're trading right now without a journal, definitely watch this video, because you're going to learn lots of things about yourself and actually things that you might not think you needed. So why do you need one? Well, in the end, your trading journal is actually the key to your trading success. Just like in anything, you want to be keeping a journal to achieve success. Whether it be you going to the gym, you're keeping track of your workouts, you're keeping track of your food. That is a journal in a sense, but just for something else. Maybe you're at work, you keep a journal of all the tasks that you need to do and what went well, what's going well, what needs to be improved. All these things you're doing in real life, you're not actually doing, and that you might not actually be doing in trading, you actually need to start doing it. So that's why we really need a trading journal in our lives. So what must be included in a trading journal? Well, I kind of picked on this at the start of the video, and the three main things that here at LogicFX that we mention a good trading journal should include is firstly a watch list. So what currency pairs and what economies are doing well and what aren't, a trade log, so the log of all the trades that you're doing, with all the statistics, the gains and whatnot, and then the performance dashboard as well, a place where you can see and benchmark yourself against other traders, but also yourself to see where you can be improved. Okay, so one point is that you don't want to be confusing the word journal and think it's just a place where you're going to be writing a few lines about your trading decision and you're done. Because contrary to popular belief, your journal, it is kind of somewhere where you need to manage everything. It's where you're managing your trades, where you're managing your psychology, your returns, and much, much more. Look at this guy. He's a power lifter. How does he keep track of, all the weight he lifts? He needs to keep track week on week, month on month, the progress he's making so that he can get stronger and stronger. And that's what we need to be doing as traders. We need to be tracking our own performance so that we can get better at trading and make sure that we're risking the right amounts, we're not taking too much risk, we're actually trading the right currency pairs and making the right decisions in general. Okay, so what is a trading journal, would you say? And in the simplest way possible, a trading journal, it's just a place where you manage your portfolio of trades. You manage your self-control and you just manage yourself. And it doesn't actually just track your progress altogether, but it also clearly identifies those areas to improve your trading returns. Really if it's one thing you're going to get from this video is a trading journal is somewhere that identifies areas to improve your own trading returns. Okay, the trading journal has a historical log of all your decisions. It has the calculators and whatnot to determine how you're performing, and it actually shows you indicators on where you need to be improving. So if you don't have a trading journal, it's really impossible to consistently scale your trading account. You can't just go out there and trading, start clicking a few buttons and think you can start being successful at trading. It's not like that. You need to start making a log, just like the powerlifter here is making a log of all the weight he's lifting. Okay, so just like a mad scientist, hey, mad scientists, what do? Well, what are they doing? They're creating hypotheses, they're making notes, they're, they're saying what went well, what didn't go well in experiments. And just as a mad scientist, we need to do that as a Forex trader, okay? Forex traders, at least the successful ones out there, use a trading journal to focus on their performance and actually pinpoint where to increase profitability, okay? It gives you a lot of those eureka aha moments where it could be something as easy as, oh, I was risking too little in these trades. Oh, not actually taking a risk reward ratio which is beneficial for my portfolio. It might identify that you're over trading. It's a lot of things a journal can actually benefit from. Okay, so let's actually go into those. What are the benefits of a trading journal? Well, the benefits of a trading journal overall are plainly to increase your profits. Going to put it bluntly, that is the sole purpose of a trading journal. It's to increase your profits and returns over a long period of time. And when you start trading, the worst feeling you can have is, let's say you have a trade, it's going wrong and you don't know why. And that question starts to loom over you, and it inevitably causes you to make really bad decisions over time until basically all your money is gone or you just over risk and blow it all. So, one of the hardest truths is to face is that no trader is perfect. You're not perfect. I'm not perfect. No one is perfect. And mistakes are going to happen. And that's what you do. Well, that's why you need a trading journal because it's what you do after those mistakes that separates winners from losers. If you take a mistake but you just blame it on something else and you're not actually logging the performance, you're not logging the decision making, then you don't actually know where to improve. You really need to go into trading with an open mind if you want to be succeeding at it. Okay? So when using a proper trading journal, all the questions like, why did that trade fail? Why did the trade work after hitting my stop loss? These questions actually start getting answered after you start logging your progress, logging your trades, all the things that are required in a good trading journal. The immense value of noticing whether it's your idea that's wrong, your risk management that's wrong, or a bit of both that's holding you back, is what that trading journal solves. And with a trading journal, you can identify how to eliminate the huge drawdowns when trading. And put simply, you'll easily be able to see what's causing you to lose money and then put a nip on it, put a plaster over it, and be like, right, that's sorted out now. So if you're able to minimize your losses on the way, the profits will look after themselves, and that's the trick to running a consistently successful trading portfolio or a trading account. Okay, so what else is a trading journal used for? Well, a lot of it is to prove that you're a good trader. It's the proof. So you're making a bit of money, trading is going really well, and now you have, you're getting investors or you really want to scale your account properly. You want to put more money in. The problem is, how do the investors know, or how do you know yourself how good you are? Your trading journal is that evidence that an investor needs, that you need in yourself, and that confidence that you need in yourself. Okay? Just making money alone isn't enough proof. What makes you a good trader is knowing the risk you've taken in order to achieve the results. Okay? What makes you a good trader is knowing the risk you've taken in order to achieve those results. So going back to that point of just making money isn't good enough, why not? Well, what if we just looked at the results? For example, if you went to the casino today and you risked all your money on black on roulette table and you just doubled your money, okay? You just bet $100 on the black, doubled your money. Would that make you a good trader? No, right? If we just looked at the results, the money made, you've just made 100% of what you bet. Exceptional returns, wouldn't it? But if we look at how you achieve the 100% return, you actually risked all your money on that trade or on that gamble. All of a sudden, you're not a very attractive investor. And if it goes wrong, you'll bust. You lose everything. Gambling. As a trader, your aim is to make a lot more money in return than you're putting in on the table. So in the roulette example, if you put in $10, but you're consistently getting $100 back, that would make you a good trader, right? This is known as minimizing your risk so your trading is sustainable. Let's take another example. Let's say you risk maybe 2% to make 100%. This looks way more attractive because now you can be wrong 50 times in a row before you actually go bust. And that gives you a cushion to soften all the times you lose and potential drawdowns. So if you can prove to others and prove to yourself that you're taking smaller risks but generating a steady return, then you can actually scale your trading account and you can believe in yourself and have confidence when trading. Okay, those are all the benefits behind a trading journal, what's actually made useful in a journal, and why you can't be looking at results. But what are actually the signs of a bad trading journal? Well, these are the three signs, just straight up. They focus on subjective commentary on trades. They don't use industry standard performance metrics, which I'll go into later, and they encourage you to just screenshot your trades, which is a complete waste of time. Okay, everyone needs a strategy. You don't trade without a strategy, and you need to be consistent in your strategy and learn it inside out. And that's kind of the basics behind a, a trading strategy in general. And it's why you need to actually use a trading journal to log that performance of the strategy. But you don't need to be taking screenshots and such. Any trading journal that is just a log of your trades and how you're feeling at the time of entering, well, it's just rubbish because they're the three red flags actually of a bad trading journal, because all they're going to do is waste your time. If a trading journal is focusing too much on non-measurable things, it's not going to be any use to you in the future, is it? And it's measuring the wrong things. A lot of these journals I've seen out there encouraging you to track useless features. The time frame you're trading. That doesn't matter in a trading journal. When you enter a trade, the time frame you looked at doesn't impact the trade's performance in the slightest. Time will always be time. You should be looking at the assets changing price over time, and that way, if you narrow yourself to only look at a few time frames, you're trading. If you're only narrowing yourself to look at a few time frames, well, your trading approach is heavily flawed, isn't it? If you're just looking at 5 minute, 1 minute, 2 minute, you kind of need to be asking yourself, am I trading correctly? And a few other things as well that make up a bad trading journal. The setup, the screenshots of the setup, waste of time. Your strategy never changes trade by trade, so this doesn't need to be tracked. You don't need to be tracking the images. In fact, if you're tracking this, then you're probably already losing money because you don't actually know if you have a proven edge, and that's why you're tracking it. Okay, that's why you really need to be learning a proper approach towards the market, especially one like the global macro approach that we have here at Logic Effects that loads of traders are appreciating, and we're getting so many thanks about it. Another one, stop loss price and distance. So many bad journals seem to think this is an important measurement, and it's not, because as we've mentioned in other videos, stop losses are just measured on volatility. So tracking this number doesn't mean anything. It doesn't mean anything at all, because stop losses, they're dynamic. They have different stop losses for each currency pair because depending on the volatility and the behavior. That tracking it doesn't do anything. We already know how much our stop loss should be per pair because we're using the ATR calculator we have in the shop. So the final point I'd say is a bad trading journal is actually the entry and exit price of trades. Why do you need to be logging your entry and exit prices? These are already tracked in your brokerage platform. All you need to be tracking is overall your floating margin of all of your combined trades, your trading portfolio. Tracking irrelevant details like entry and exit prices is just wasting your time. So if you're finding yourself journaling in this way, what you really need to see is what we're doing here at Logic Effects to scale your skills as a trader. So what does a good trading journal look like in the end? Well, as I mentioned before, there are three main things a good trading journal needs to look like, and I've got an Excel sheet template right here. Firstly is the watch list. Okay, this will be the watch list. I'll go into it in detail. Secondly is the performance overall of your trading portfolio. So it'll have all the statistics, the starting balance, how much you're gaining, the Sortino sharp alpha betas, which we'll go into in a minute, and also how much you should be potentially risking, basically. That is the Kelly criterion, and that's what you'll build up over time as you start trading. We also have the exposure limits, another thing we'll go into in a bit. But firstly, let's go over the watch list. So what is a watch list? Well, watch list is basically an area where we're inputting the data. So We have some data about United States, Europe, South Africa here. This is just the economic region. What we've done is use our technology. So we've got the logic currency strength meter here, logic effects currency strength meter, the COT sentiment, and the overall political themes. Now you can actually go ahead and start trying to make this. Just take a screenshot, pause the video, and start creating these headers. And what this does is it starts building out areas of interest that you should be focusing on, because there's so many currency pairs out there that you just don't know what to focus on, right? Well, this is what a watch list does. It helps you filter that down. Next, we actually have the actual watch list, which is putting down the currency pairs. For example, Euro USD. We have an overall bias that we want to be shorting it. This is because the logic currency strength meter is -32 for Europe and +52 for the United States in this example. Okay, so this is where we start actually populating the watch list itself and start adding currency pairs and things to watch and assets to watch out for, because they're of our most interest and they're the most probable trades to take. We also are following a traffic light system. So this is why you'll see green, amber, reds maybe in these cells, is because we're following a traffic light system. So what that means is when it's red, it's not ready and we need to start waiting. Amber is almost there, wait a little bit longer. And green means, right, this is ready, it supports our idea. So for example, in the EURUSD short idea, COT is green. And this means that the COT sentiment of the market's actually agreeing that, yeah, EURUSD looks like a good trade. Technical analysis 1, that's what TA1 stands for. For example, a RSI indicator. That's also green. That's potentially suggesting that EURUSD is good for a sell. Technical analysis 2, we've got an example, supply and demand zones. It's amber. Ooh, you're not just in a supply zone yet. Maybe wait a little bit longer till it hits that zone and you could be good to go. Okay? These technical analysis columns, you can add as many as you like. Just make sure that they're useful to you. And this is basically where you start adding all your Forex pairs. So that's where I'd add it, the date that you entered the idea, and then start populating along the things that you need for good decision making. Now, what we found useful was that we always follow the currency strength meter. We always include the COT sentiment. We also include some relative analysis, which we discuss in our trade idea blogs, and also technical analysis. So those are the main key things that we need in our trading journal watch list to make sure we're focusing on the right currency pairs. And then in the performance tab, we want to be going in and actually tracking our own performance. So you can see here that we have a nice graph of our equity, so it's our overall trading gains, and then our win ratio, and also our overall wins and losses. And you can kind of see that overall, if you have a below 50% win rate, that's completely fine. And you can see that it's gaining money. It means that you're taking the correct risk reward ratios, because you're actually gaining more than you're losing, if that makes sense. So you're gaining more when you're winning than you're losing when you are losing. So if you actually have a higher win rate, a win percentage here, but your gains are steady, they're flat, or they're falling, it potentially means that you actually are not taking a correct risk reward ratio. We always aim for a 1-to-3 risk reward ratio based on the volatility of the markets. Okay, so down here is where we start actually including some of the interesting performance statistics. So on the left here, we have our starting balance, which we type in. And then basically what that is you type in any starting balance that you start with. So let's say, for example, I start with $25,000, I put that in. Or if I start with $2,000, I put that in here. Okay. And then the rest of these statistics will start to auto-populate. In the weekly performance tab, though, this is where you want to be basically taking log of your overall floating margin. So when I mentioned before, the main really interesting point is you want to be seeing overall, is my margin growing? Is my account actually growing? And that's all you do. Week by week, you just want to be putting in, how much has my account grown by? Okay. And you just keep doing that. All of these other performance cells will start automatically populating through our Excel formulas. You can see overall how much it's growing. Then on the side here, you can just put month by month, each month, how many trades did I take, how many winners were there, how many losers, and the overall margin, which is the same over here. Then we also have our statistics. So there are 5 main statistics here that we're actually really interested in, which is the beta, the alpha, the Kalman ratio, Sortino, and Sharpe. And all you really need to know is we made some really good notes here, is that for a Sharpe ratio, basically it's a risk reward ratio. If it's greater than 1, you're a good trader. If it's greater than 2, you're an exceptional trader. Okay? For a Sortino ratio, greater than 2, good trader. Greater than 3, exceptional trader. Kalman ratio, same thing applies. Greater than 2, good ratio. Greater than 5, excellent ratio. Now the alpha is basically, if it's greater than 0, it means you've outperformed the markets. And the beta is your correlation to the benchmark. So in this case, the benchmark is S&P 500. How closely are your returns correlated to that? And in this case, a negative number means that there's a negative correlation, whereas a positive number would be there's a positive correlation. So a +1 would be a 100% positive correlation, and a -1 would be a minus 100% negative correlation. And then here we have a few other statistical numbers. So the annual risk-free rate would be the US bond yields. And then we have some other gross exposure limits over here, which I'll cover in another video because it's basically a calculator to determine your overall exposure to the markets and basically how much you should be positioning in each trade. So now that we've gone over the performance statistics and basically what goes on, you also want to add the S&P benchmark over here because that gives you an idea of how much you're earning in comparison to the overall basically stock market, the benchmark towards which most funds benchmark their returns against. Once you've added all that and you've got all the statistics, you can start seeing whether you're a good trader or not. And that's why we've automatically populated all these fields for you, so that all you need to do is go ahead and change your starting balance. For example, if my starting balance is 2,000 here, then go ahead and change that. Go ahead, you change your starting balance for 2,000. Okay? And what you want to be doing is basically populating that as you go along, so that right now it's just dummy data. It's data that I'm using for this video as a tutorial. And once you start adding data of your trades, of your performance, you can start actually seeing overall the performance of your trading account, where to improve on, and actually how well you're performing to the markets. Because if you're not performing greater than the markets, then what's the point in trading yourself? Why don't you just put it in the market, right? We also have the trade log, which is basically the Kelly criterion here. And what the Kelly does is it returns a number, which is basically how your optimal bet size, basically. And what you should be doing here is tracking all your losing and winning trades along here. The Kelly criterion formula will basically work it out here, how much you should be risking. And here it says, well, you have a 25% optimal bet. But that doesn't mean go and risk 25% of your account. It just means whatever you're risking now, you can probably start increasing that risk based on your performance. Does that make sense? So if you're currently risking, let's say 1%, and the Kelly is saying, well, you should be risking like 20%, that means you can start upping it. Feel confident in yourself. The performance is saying you're a good trader. Start upping your risk. Get into 1%. Go from 1% to 2%, 3%, 4%. Start trading like that. Keep on logging this, and the Kelly criterion will slowly change. And that's what makes a trading journal so important, because as you start trading, you start entering these trades, you start logging your performance, you actually start getting better and better statistics about yourself and actually where to improve. And if you're not doing this, you're not following a proper trading journal, then you don't know where to improve. It's basically a coach in an Excel sheet. And that's why it's so important to have this within your own trading, and why you should be always trading with a trading journal. So if you actually want access to this trading journal, and we've got an Excel sheet in the link below, there will be up to a 99% discount on this. So you go ahead and take advantage of that coupon code before it runs out. But basically, if you're stuck, you don't know how to actually create a trading journal yourself, this is the exact template you'll be looking for moving into 2020 and 2021 next year. And if you really want to be having a really good performance in 2021, I'd go ahead and start using this Excel trading journal template straight away and start applying it as soon as possible, because that's when you can actually start seeing your statistics to see where you need to be improving. The faster you identify where to improve, the faster you'll be successful at trading. Thanks for the video, everyone. Make sure to use the code in the description below to get yourself this template, get up to 99% off, and I'll see you in the next one.